So you're thinking about owning a small apartment building. From the sidewalk, the business looks almost mechanical. Several front doors, several rent payments, one property, and a mortgage that tenants help you pay down over time. But the purchase price is only the visible part. The real test is whether the building produces enough net operating income to cover debt, taxes, insurance, repairs, vacancies, management, and major capital work. In this breakdown, you'll see how a 5 to 20 unit property is financed, where revenue comes from, which expenses can damage the deal, how value is created, and why a high rent roll does not automatically mean a strong business. The first change happens when you move beyond the world of a typical 1 to 4 unit residential property. A 5-unit building is already treated as multifamily collateral in major agency lending programs. That does not make your finances irrelevant. Property income becomes central, but borrower experience, financial capacity, liquidity, guarantees, and loan structure can still matter. One useful benchmark is Fannie Mae's small mortgage loan program. It covers existing stabilized multifamily properties with at least 5 units, permits acquisition or refinance loans up to $9 million, lists maximum leverage of 80% loan to value, and requires at least a 1.25 debt service coverage ratio. Those are program parameters, not promises that every buyer will receive them. That 1.25 ratio is the first number an aspiring owner should understand. Debt service coverage ratio compares a property's net operating income with its annual mortgage debt service. If a building produces $125,000 of NOI and annual principal and interest payments are $100,000, the DSCR is 1.25. The lender is not looking at the entire rent roll and calling it available for debt. Operating costs come out first. A building may collect impressive gross rent and still be a weak borrower if taxes, utilities, payroll, repairs, insurance, and recurring management expenses consume too much of it. This is where apartment ownership stops looking like collecting checks and starts looking like running a small operating company attached to a physical asset. And that is the purpose of this channel, opening the books on ownership instead of stopping at revenue. We look at what businesses and income-producing assets cost to buy, how they are financed, where operating money goes, what creates cash flow, and what risks sit between a strong top-line number and actual owner income. A small apartment building is a perfect example because the revenue can be unusually visible while the liabilities remain easy to underestimate. Start with the acquisition. There is no honest national purchase price for a small apartment building because values change dramatically by metro, neighborhood, age, unit mix, rents, condition, and local cap rates. So use a simplified model instead of pretending one price fits the country. Suppose an 8-unit property is offered at $1.2 million. At 75% financing, the loan would be $900,000 and the equity check would be $300,000 before closing costs, lender fees, inspections, legal work, reserves, and any immediate repairs. At 70% financing, the equity requirement becomes $360,000. That difference matters because leverage is not just a financing detail. It determines how much cash remains outside the deal to survive the first boiler failure, roof leak, insurance renewal, or vacancy spike. The building also has to survive due diligence. Multifamily financing commonly involves an appraisal, environmental review, and property condition work. The roof may have 3 useful years left. The parking surface may be approaching replacement. Electrical panels may be obsolete. Plumbing may be at an age where one repair becomes a pattern. A central boiler can make maintenance feel cheap for years and then create one large capital event. None of those items appear in scheduled rent, yet all of them compete for the same cash generated by the property. If the acquisition model assumes repairs will behave like a smooth monthly expense, the model is already more orderly than the building. Fannie Mae's conventional multifamily documentation specifically identifies appraisal, Phase 1 environmental assessment, and property condition assessment among standard third-party reports. Then comes the revenue side. Base rent is the foundation, but it is not the same as collected revenue. Scheduled rent is what leases say should be billed. Economic occupancy asks how much income actually reaches the property after vacancy, concessions, non-payment, and other losses. Owners can also have legitimate secondary income from parking, storage, laundry, pet-related charges, or utility reimbursements where local law, leases, and program rules allow them. These smaller streams matter because $1 of recurring income can improve NOI without adding another apartment. But they are not automatically pure profit. Laundry equipment breaks. Parking areas need maintenance. Billing systems have costs. Local rules may limit fees or utility allocations. The right way to treat other income is as a real operating line with its own expenses and legal constraints. Utilities are a good example of how the physical design of the building becomes financial design. In one property, tenants may have separately metered electricity while the owner pays water and common area power. In another, the owner may carry most utilities. Some properties use lawful utility reimbursement systems, but the rules differ by jurisdiction and by housing program. The economic effect is straightforward. Every recurring utility bill paid by the property reduces NOI unless it is offset by rent or a permitted reimbursement. That makes old plumbing fixtures, leaking toilets, inefficient common lighting, boiler performance, and submetering strategy more than maintenance details. They change the income that remains available for debt service and reserves. Housing choice voucher tenants add another nuance. The federal voucher program is often discussed as if it makes an entire tenancy guaranteed, which is too simple. Under HUD's program, the Public Housing Agency pays the housing assistance portion directly to the landlord, while the household remains responsible for its required tenant portion. That can make part of the rent stream more predictable for a participating owner. But the property also operates within program requirements, inspections, rent reasonableness rules, and local housing agency administration. The useful lesson is not that one tenant category is automatically better. It is that the reliability, timing, and rules attached to each revenue source matter when a lender is judging whether the property can consistently service debt. Now, take the income statement apart. Gross potential rent sits at the top. Subtract vacancy and collection losses, then add legitimate other property income, and you reach effective gross income. From there come operating expenses, property taxes, insurance, repairs and maintenance, management, owner-paid utilities, landscaping, cleaning, payroll if there is on-site staff, administrative costs, contracted services, and other recurring items. After those operating expenses, you reach NOI. Mortgage principal and interest are not usually deducted in the conventional NOI calculation. Neither are income taxes, owner distributions, or many capital expenditures. That distinction is crucial because a property can report healthy NOI and still leave the owner with disappointing cash flow after debt service and major capital spending. Valuation adds another layer. Income-producing apartment properties are often analyzed using capitalization rates. In the simplest form, value equals NOI divided by the market cap rate. Treat this as a valuation framework, not a guaranteed sale price. If a stabilized property produces $90,000 of annual NOI and buyers in that specific market require a 6.5% cap rate, the indicated value from that simple calculation is about $138 million. If NOI rises to $100,000 and the market cap rate stays at 6.5%, the indicated value becomes about $154 million. That is why owners obsess over recurring income and recurring expenses. Improvements to sustainable NOI can affect both current cash generation and perceived value, but the second half of that formula is outside the owner's control. If market cap rates rise, the same NOI supports a lower valuation. At $100,000 of NOI, a 6.5% cap rate indicates roughly $154 million, while a 7.5% cap rate indicates about $133 million. The owner could improve operations and still see market value pressured by financing conditions or investor return requirements. This is one reason appreciation should never be treated as operating income. It is also why buying a building with a plan that only works if cap rates fall is a different bet from buying one that works because rents and expenses already support the debt. Property taxes can create another surprise because assessment rules vary widely. A sale may affect taxable value in some jurisdictions, while other places use different reassessment schedules, caps, exemptions, or formulas. The safe underwriting approach is not to copy the seller's current tax bill and assume it continues unchanged. The buyer needs to investigate the post-acquisition tax treatment for that exact parcel and jurisdiction. The same discipline applies to insurance. A 2025 Federal Reserve analysis of apartment properties found that higher insurance costs were associated with lower net income, and it estimated that a $1 increase in property insurance cost was associated with about 74 cents less net income. In other words, rent does not automatically adjust fast enough to make insurance inflation disappear. Insurance also illustrates why a lease can lock revenue while expenses keep moving. A tenant may be under a 12-month lease. The renewal date for the property's insurance does not care. Neither does the utility company, the county tax calendar, the elevator contractor, or the plumber responding to a broken line at 2 in the morning. Apartment ownership therefore contains a timing mismatch. Portions of revenue are contractually fixed for a period, while many costs can reprice sooner. A conservative owner plans for that mismatch instead of treating the latest 12 months of expenses as a permanent ceiling. Maintenance deserves its own category because owners often confuse routine repairs with capital expenditure. Replacing a faucet cartridge is not the same economic event as replacing a roof. A turn between tenants is not the same as repiping a building. The first group can often be absorbed through recurring operating budgets. The second can require tens or hundreds of thousands of dollars depending on the property. This is why replacement reserves matter. Fannie Mae's multifamily terms commonly contemplate replacement reserves, and tax and insurance escrows may also be required depending on the transaction. Even when a lender allows flexibility, the building itself still creates those future obligations. A reserve is not idle money. It is money assigned to problems that have not arrived yet. Now return to that hypothetical 8-unit purchase. Assume, only as an educational model, that the property collects $1,400 per month after normal vacancy and collection loss, or $172,800 per year. Add $7,200 of permitted other income, producing $180,000 of effective gross income. Suppose recurring operating expenses total $72,000. NOI is then $108,000. If annual debt service is $84,000, DSCR is about 1.29, and cash flow before income taxes and major capital expenditures is $24,000. That $24,000 is not the same as profit safely available to spend. If the roof reserve needs $8,000 that year and an unexpected plumbing project consumes another $6,000, the cash retained by the owner falls quickly. Now change only one variable. Insurance and taxes together rise by $12,000 at renewal and reassessment. NOI drops from $108,000 to $96,000 with the same $84,000 debt service. DSCR falls from about 1.29 to about 114. The property may still be paying its bills, but the cushion that made the original financing look conservative has nearly disappeared. That is the real power of DSCR as a management concept. It is not merely a box checked at closing. It shows how much room exists between operations and mandatory debt payments. A building with a thin cushion can become fragile without losing a single tenant. The same stress appears with floating rate debt. Variable rate multifamily loans exist, and they can be appropriate in some transactions, but they change the risk map because debt service itself can move. If rent is locked by leases while interest expense rises, coverage can compress from both directions at once. Fixed rate debt does not remove risk, but it can make one of the largest recurring cash commitments more predictable. The correct choice depends on the transaction, term, prepayment structure, refinancing plan, and borrower, which is why always choose fixed is too absolute. The ownership lesson is simpler. Never model financing as if the cost of debt cannot change unless the documents truly make it fixed for the period you are analyzing. Fannie Mae's current small loan program offers both fixed and variable rate options. Non-recourse language also needs careful handling. Some agency multifamily executions are available on a non-recourse basis, but non-recourse does not mean nothing can ever reach the guarantor. Fannie Mae explicitly describes standard carve-outs for bad acts such as fraud and bankruptcy. The exact recourse events and loss obligations come from the actual loan documents. That is very different from claiming that one late tax or insurance payment automatically turns every commercial mortgage into full personal liability. A buyer should have qualified counsel explain the guarantee, carve-outs, cash management provisions, transfer restrictions, insurance duties, bankruptcy provisions, and other covenants before signing. The dangerous assumption is believing the marketing label is a substitute for reading the contract. Operationally, the most resilient owner is usually not the person extracting the maximum possible distribution every month. It is the person who understands how many separate systems are making promises against the same rent roll. The lender expects payment. The city expects compliance. The insurer expects premiums and risk controls. Tenants expect habitable units and timely repairs. Vendors expect invoices paid. The building expects replacement of components as they wear out. If every available dollar is distributed to the owner, the property has no shock absorber. Strong cash management therefore means separating spendable owner cash from money that economically belongs to upcoming taxes, insurance, repairs, deposits, capital projects, and debt service. Management changes the equation again. An owner-operator may keep management fees in-house, but that does not make management free. Leasing, screening, bookkeeping, rent collection, inspections, vendor coordination, after-hours calls, compliance, renewals, and turns consume time. If the property becomes large enough that the owner hires professional management, the fee becomes explicit. If the owner performs the work personally, the cost is partly hidden in labor. Comparing two buildings without accounting for that difference can make the owner-operated property look more profitable than it really is. Owner compensation and property profit are not the same thing, so what actually creates wealth in a well-run apartment property? There are several separate mechanisms and they should not be mixed together. First is operating cash flow after expenses and debt service. Second is principal reduction as scheduled mortgage payments pay down the loan. Third is any increase in sustainable NOI that may support a higher valuation depending on the cap rate buyers require. Fourth is market appreciation, which can occur but is not guaranteed. Fifth is the tax treatment of rental real estate, which can affect after-tax results but depends heavily on the owner and transaction. A good analysis keeps each mechanism in its own box instead of presenting all of them as spendable annual profit. For a first-time buyer, that leads to a more useful question than how much rent does it collect? Ask how much effective income remains after normal loss. Ask which utilities the owner pays. Ask what the real tax bill could be after purchase. Ask for current insurance indications, not a stale premium from years ago. Ask what the roof, plumbing, electrical system, parking, HVAC, elevators, and common areas are likely to require. Ask whether rents shown on the offering are current contractual rents or projections. Ask how much cash remains after debt service under a bad but plausible year. And ask what happens if refinancing is more expensive than expected when the loan matures. That last question matters, because many commercial multifamily loans do not behave like a 30-year home mortgage that simply amortizes until it disappears. Loan terms, amortization periods, balloon maturities, prepayment provisions, and refinance requirements vary. A property may have a long amortization schedule but a shorter contractual maturity, creating a future refinance event. If the next lender values the building more conservatively, requires more coverage, or offers lower leverage, the owner may need additional equity just to replace the existing debt. Refinancing should therefore be modeled as a future risk, not assumed to be an automatic reset button. Freddie Mac's small balance loan materials, for example, pair shorter fixed-rate loan terms with amortization periods that can extend to 30 years. A strong ownership plan is boring in exactly the right places. It uses rents that can be supported, expenses that include realistic maintenance, financing that leaves coverage, and reserves that remain in the property until the risk they were assigned to has passed. It does not count appreciation to make monthly debt service work. It does not assume every vacant unit will lease instantly. It does not assume every fee can be increased without legal or market resistance, and it does not treat a lender's maximum loan amount as the owner's ideal loan amount. The safest capital structure is the one that gives the building time to recover from problems. This is also why two owners can buy nearly identical buildings and get completely different results. One buys at a price supported by current income, uses moderate leverage, funds reserves, performs repairs early, and accepts lower distributions while the property stabilizes. The other stretches to the maximum debt available, underwrites aggressive rent growth, postpones capital work, and depends on a future refinance to solve today's thin cash flow. In a rising market, both can look intelligent. During an insurance shock, vacancy problem, expensive repair cycle, or tighter credit market, the difference appears. The building did not suddenly become a different business. The capital structure revealed which owner had room to make mistakes. That is the central economics of owning a small apartment building. The rent roll is important, but it is only the starting fuel. The business is really the management of a leveraged physical system. Apartments producing recurring income, expenses constantly competing for that income, debt converting part of it into equity over time, and reserves protecting the entire structure when the building behaves like a building instead of a spreadsheet. The best owner is not necessarily the one who pushes rent highest or borrows most. It is the one who can keep the property safe, compliant, occupied, maintained, and solvent through ordinary bad years. If you remember one idea, Make it this. A small apartment building does not become safe simply because people need housing and rents arrive every month. Safety comes from the space between what the property reliably earns and everything it has promised to pay. That space is created at purchase, protected through operations, and tested every time an expense rises or a unit goes dark. Buy too aggressively and the rent roll serves the debt. Buy and operate with enough margin and the debt can gradually serve the owner. That is the difference between owning several apartments and owning a durable apartment business.